Why does your payment go up or down after you purchase the house? All right, we get this question a lot, and there's a lot of different reasons why your payment could go up. Mostly it seems like it goes up, but there are some situations where it could go down, which I'm going to talk about as well. First, let's start with property taxes. If you were purchasing a newly built home and the land with that dwelling has not been assessed yet through the county assessor's office, then the property taxes that the lender is going to use are estimated. So depending on what they're estimating, once the property is actually assessed, your property tax portion of your payment could increase that would then change your overall payment structure. So for example, let's say you're buying a brand new house and the lender's estimating $50 a month for your property taxes. But in reality, once the house is assessed, maybe your monthly property taxes is really $100 a month. In that scenario, depending on when the house is assessed versus how much money you have in your escrow account, you could even potentially have an escrow shortage in your account. So when we are working with clients purchasing a newly built home, we're trying to estimate as close as possible what we think that the property taxes are going to be. Now, in that scenario, you could actually have an excess in your escrow account on newly built homes. And what happens in that scenario is that's your money and you would get it back if there is truly an excess, because federal law dictates that lenders can only keep so much money in a borrower's escrow account. And so it has to be analyzed every year. And if there's too much money in there, that's why you get an escrow refund. If there is not enough money in there, it would be called an escrow shortage. And this leads me to another way that your payment can go up. Let's say that my scenario is accurate and maybe you were paying $50 a month as part of your payment. Once the house is assessed for property taxes, now your real payment is $50 higher. So now we should be collecting $100 a month for your property taxes. But let's say that now, based on when the property taxes are assessed, you have a shortage because you've only been paying $50 a month instead of the $100 a month. Now your payment might go to $125 until that escrow shortage is paid, and then it would drop down to the $100 a month on the property tax threshold. I know, confusing stuff, but it is important to know property taxes are a reason why your mortgage payment after you purchase a home can go up or down. Now, we don't very often see that property taxes go down, but it could be plausible. And so if your payment is going down, maybe it's because of property taxes. But in most scenarios, we see it because property taxes have increased, and then therefore the lender is going to increase the amount that they have to collect to ensure that they have enough money to pay your property taxes if they are escrowing for taxes. All right, let's move into homeowners insurance. Same deal. Now, it's all over the media, right? We know that there are certain parts of the country where homeowners insurance costs have increased dramatically. And that could be a very real reason why your payment is now increasing. Let's say your homeowners insurance company gives you a quote of $1,200 a year. Then the lender is going to set up your payment at $100 a month for that homeowners insurance to equate to that annual premium that your insurance company has provided to you. And then let's say at your renewal, and we do see this a lot, your renewal, your insurance company comes back and says, hey, now your premium is $1,400 a month. So when that happens, know that you have the ability to shop homeowners insurance. What you closed with, the insurance company you closed with, does not have to stay with you forever. And it's a great opportunity just to take a step back, contact your insurance company roughly 60 days before that annual renewal premium, and ask them what is their quote for the following year. Because we also see that many homeowners insurance companies know, especially for buyers that have their insurance escrowed through the mortgage lender, that it's out of sight, out of mind. So people aren't really thinking about what the annual premium is once that policy is secured. So in those scenarios, it could be that maybe they're coming in lower than what the traditional premium should be, knowing that you're escrowing for your homeowner's insurance and knowing that they're going to increase year two. So again, just making sure that you're asking really great questions and that you're vetting your homeowner's insurance companies so you're comfortable. And again, if your insurance goes up, because stuff happens and insurance just can go up. Not because it was intentional, but because of other things that might be happening in your market. In that case, know that you can always shop for new homeowners insurance. Be sure that you're reporting back to your lender if you are changing insurance companies after you've closed on your loan, and then they will set up your payment, i.e. what's going into being collected and going into your escrow account based on that new policy. Now, maybe you scored a great deal and your homeowners insurance is going down, which could mean that your monthly payment would go down. All right, principal reduction. This is another scenario where we do have a lot of people that are relocating and they need to sell a house, but they're going to buy the new house before they sell this other house. And in that case, maybe they're going to, once that house sells, have a lot of money that they want to take some of that money and put it down as a principal reduction on the new mortgage that they already closed on. In that scenario, doing a principal reduction does not automatically drop your mortgage payment. Your mortgage payment's going to stay the same unless, and here's a secret, unless you do a recast. So if you know that that's your intention, buy a new house, sell this house, take the proceeds, put it down on the new house, you want to be sure before you close on that new mortgage that your lender offers what is called a recast. And a recast does this. Without having to refinance, it allows you to pay a principal reduction, and every lender has like different rules around it, but in theory it all works the same. You're going to do a principal reduction, then the lender is going to reset your payment based on the new loan balance. In that scenario, could drop or lower your mortgage payment. So it's a great strategy and very cost effective, and you don't have to pay for refinance fees. And assuming interest rates aren't lower, maybe they're higher than what you secured, then you're not subject to current market rates. So I love me some recast strategy. Okay, adjustable rate mortgages. This is another reason why your payment could go up after you purchase a home. Now, adjustable rate mortgages most often are going to be more of a hybrid adjustable rate these days. And that is by hybrid, meaning that it's fixed generally for a period of time. So let's say you're doing a 3-year fixed, a 5-year fixed, a 7-year fixed, or a 10-year fixed. All of these are hybrid types of adjustable rate mortgages. But after that initial fixed rate term, your payment will adjust based on the index and the margin of the adjustable rate that you acquired. So again, depending on what your initial note rate was versus what is going on with the index at the time that your loan is getting ready to adjust, your payment could go down or your payment could go up. So again, that's just another payment factor, if you will. And then the last one is mortgage insurance. Now, mortgage insurance works different based on the home loan type that you are acquiring. The most common 2 home loans that we're using in this country that have mortgage insurance on them are conventional conforming home loans, which are secured through Fannie Mae and Freddie Mac, or FHA home loans. And the way mortgage insurance works is completely different between these 2 different categories. So let's start with FHA. On FHA, if you're putting the minimum down payment of 3.5%, and heck, if you're putting less than 10% down, the mortgage insurance on an FHA loan is never going to drop off unless you sell or refinance that mortgage. It's just the way that the program is structured. So don't get confused, because there's a lot of chatter out there that once you get 20% equity in the home, then your mortgage insurance drops off. That doesn't apply to FHA loans. Now, in FHA, if you're using that type of mortgage and you're putting more than 10% down, then you are going to have that mortgage insurance for 11 years. Again, it's not going to drop off in year 2, 3, 4, 5, or 6 based on the equity position of your home. Not the way FHA works. We pop over to conventional, completely different. So in conventional, mortgage insurance is automatically going to drop off at a certain threshold once your loan to value reaches a certain ratio, or let's say you've done some improvements to the house and that has increased your market value. You can go back to your lender and talk to them about eliminating mortgage insurance. And you can do that much faster on a conventional home loan, depending on market appreciation, if you're doing home improvements, principal reductions, all of those could factor into the mortgage insurance element of your overall payment. Now, that was a whole lot, I know. What's important to know is if you have taken out a fixed rate loan, fully amortized fixed rate loan, so most often that's going to be a 10-year a 15-year or a 30-year fixed rate loan, then that portion of your mortgage payment isn't going to change. But the rest of your mortgage payment, that's where you can see changes after you purchase a house. Hopefully that helps. If you have questions or you're in a unique scenario and something's going on with your mortgage payment and you have questions, don't hesitate to reach out. 480-725-0150.